Welcome to Lecture 20, Venture Capital. So let's look at our first capital source, venture capital. Now, the most distinctive characteristic is that typically a venture capital fund will need the idea to be a billion-dollar idea or greater. So they're looking for really big exits within the next 3 or 5 years, preferably 3 years. They're looking for 10 times the return on their money, and they're going to expect between 20 to 30% of your equity. And I want you to keep in mind that they often invest for others, so a venture fund typically is a professional money manager. Typical investments are generating $1 million in revenue or have 1 million users or more. The sectors you'll most commonly see venture capital in are software, internet, and digital media. Now, there are some exceptions here. Investors who are interested in biotech, medical devices, and life science use different metrics, which are clinical trials and government approvals, to gauge readiness for investment. So, what I want you to understand about venture capital is that if you don't have a really big idea, it's probably not going to work out for a venture capital fund. So, in our mock example, we have managed to get a valuation of $6 million for our Series A round, so we can give away 25% of our company for $2 million. So now stop for a second and imagine if our valuation was only $1 million. That really wouldn't have worked. So let's do the calculations. So we calculate this by adding our pre-money valuation, which was $6 million, to the amount that was raised, which was $2 million. That's how we get our post-money valuation. $6 million plus $2 million equals $8 million. And if we gave away $2 million, then we'd have to give away 25% of our equity. So you can quickly see as if we replace that $6 million with a $1 million, the numbers wouldn't work. So if your valuation were lower than $6 million, it would be hard to justify accepting venture capital dollars. Say your valuation was $2 million. $2 million plus $2 million gives you a post-money valuation of $4 million. And $2 million over $4 million is 50%. You would not want to give away 50% of your company in the first equity round, because keep in mind, you may do future equity rounds. Don't despair. If your company is too early for venture capital, there are other ways to finance your company. Let's look at a few other financing options.